for joining me today. My name is Wesley Boudreau, one of the financial advisors here with the Retirement Group. Today we're going to talk about Roth conversions, and we'll go over some different strategies we use time to time for a lot of the corporate employees we do work with and help transition into retirement. Before I get started, just if anybody's got any questions, there is a Q&A box that you can feel free to put your information in there, and I'll try to address as many as I can at the end of the webinar. It is anonymous, so your name will not pop up, just the question. There's also a chat box in there, so if you have, we'll give you updates on how to schedule a meeting with myself or one of the other advisors in the office, how to follow us on LinkedIn. There'll be a survey there if you want to give us some critique or ideas of other webinars you'd like to see from us. And then also potentially a link to one of the next webinars if you'd like to sign up that way as well. But I do want to remind everybody that we've been working extensively with a lot of different companies for the last 30 years, but we are not employed by nor endorsed by your specific company. But again, any company-specific questions beyond these Roth conversions, give us a call. We'll be happy to go through those as well, because again, we've been working with many companies for 30 years or so. We do have offices throughout the country, so rest assured, if you need to sit down with somebody face-to-face, we can still accommodate that. However, we can also do web meetings, phone calls, email, all that's available as well, and very easy to communicate via that way. And if you haven't done so in a while, or if you haven't done so ever, the best thing to take us up on is our complimentary cash flow analysis. This is the ability to actually see if you're on the right path to retire based upon your desired goals. We can actually take a look at what your desired retirement date is, what you want to spend in retirement, and then what you've been saving along the way, and figure out, are you on the right path to retire at that time? Or we'll not happy to tell you, but we will tell you if you need to work longer or save more. We'll be happy to tell you if you've gotten to the point where you can actually retire earlier if you want to. But we're going to be rest assured that that on a conservative basis you can do that before we say something of that nature. We're going to talk about Roth conversions here, and that plays into a lot in that cash flow analysis as well. But ultimately speaking, the retirement decision is going to also factor around your company-specific plan. So give us a call on those, and we can go through what's happening with your company and whether it makes sense to pull the trigger at some point in time, because we're seeing a lot of changes with interest rates affecting pension lump sum calculations and also 401k performance at this time. So we're going to go through a lot of different things. We'll go through some different diagrams of the basic Roth contributions, conversion options, and go through an example or two just to give you an idea of what that will look like. But at the end of the day, it's going to be best to give me a call so we can run through your specific situation, because everybody's going to have a different tax bracket and it'll be treated differently. We can look at what it's going to look like for you, not just now, but over the long term, 10, 20, 30 years down the road, and what the benefit's going to be just for yourself and possibly your beneficiaries. But ultimately speaking, if you want to make a contribution to a Roth IRA, there are limitations to that, and based upon your income, your earnings. But if you end up making over $144,000 right now in 2022 as a single filer, single taxpayer, you cannot make a Roth contribution. If you're joint and it's over $214,000, you cannot make a Roth contribution. However, you can make an IRA contribution. So one option to still get that in there, because they haven't closed the conversion process yet, is to make a non-deductible contribution to a regular traditional IRA, and then turn around and convert that, pay the taxes. Convert that. You don't have to pay the taxes, you already paid them, but turn around and convert that over to a Roth IRA. Now, if you did this immediately and you didn't have any growth in it, that's fine. But if there was a little bit of growth in there, that's where you'd pay the taxes on that conversion process there. And the limits, just so everybody remembers, is $6,000 you can put in per year. If you're over 50, you can do an extra $1,000, so $7,000 potentially you can get into that Roth IRA, either directly if you have low enough income, or indirectly by going through the backdoor option by going through the IRA first. Now, when it comes to the 401ks, that's what we're going to talk a little bit more about, because you can actually maximize more benefits here with your getting money into the Roth, even if you're not doing the Roth 401k option, or if your company does not offer a Roth 401k option. But what's going to happen is you could actually potentially do up to about $38,500 if you can afford to do that, in addition to that potential $7,000 we mentioned for those over 50 in the regular Roth contributions. But in order to be eligible for this, it's going to depend upon company by company 401k plan. But first and foremost, they need to give you the option to have after-tax contributions that you can put in beyond the pre-tax limits. They need to also give you an in-service withdrawal option, not just a hardship. A hardship withdrawal doesn't count because that's for something different, but give you in-service withdrawal options, and most do against the after-tax, not necessarily the pre-tax, but against the after-tax. And then again, if you're over 50, you can do an additional $6,500 if you can afford to in that as well. And that's where you can kind of maximize some of those. But the process to actually do that is, again, to potentially maximize your after-tax contributions. So not your Roth contributions. If you put your Roth 401k, if it's got that, that will satisfy the Roth option. But again, you're limited to the choices in the 401k plan. Whereas if you can put money into an after-tax and then turn around and roll that over directly to a Roth IRA, now you've got a lot more choices for the investment strategy, whether you do things on your own or work with a company like the Retirement Group to help you manage that. But ultimately speaking, you would be rolling over your after-tax cost basis, so they call it the post-86 contributions, to a Roth IRA. And if you've had any earnings in there, that can roll over directly to a rollover IRA. So again, it's not taxed, but that will continue to grow tax deferred just like it would have done in the 401k plan. Well, let's take a look at a basic example to kind of get a little bit better on this. And so in this example, let's assume that you've got the money to do it and you're maximizing everything. So you're going to, the max is going to be $61,000 across the board that can go in. So in this case, let's assume that your company puts in $2,000, not much, but let's assume they put in $2,000. Then you put in your pre-tax contributions, or you could have done a Roth contributions of $20,500. That's going to leave you with $38,500 that you could be putting in on an after-tax basis. Now, once that after-tax is in there, you can turn around and actually roll that over, again, if your plan allows, to a Roth IRA. So now that $38,500 can start growing tax-free as long as you keep it there for at least 5 years and make it to age 59.5. We'll talk about the taxation here in just a moment. But again, so essentially you put in whatever you can, the max that you can in the after-tax into the 401k, up to that $38,500. And then later that year or the following year, you can go ahead and roll that over to a Roth IRA, again, depending upon the company's specific regulations. Most companies allow you to do it. Some companies allow you to do only once per year. So again, if you have questions on this, give us a call and we can go through it with you. Especially if you've already got some post-86 tax contributions in there, it's definitely important to look at this because this was a potential option that they were talking about changing last November and December. That has not gone through, and I don't think it's going to go through now. But it's still good to keep in mind that this may not be here forever. Now, if we look at the taxation and how it's different between a 401k or a traditional IRA versus a Roth IRA, those tax-deferred investment vehicles, they're great because they allow you to defer your taxes, in which case you're not going to pay any taxes until you physically take them out, so it saves you taxes along the way. But ultimately speaking, once you do decide to take that money out, it's going to be fully taxable. If you take it out before 59.5, you could also have a 10% penalty on top of that taxation. So it's really important to understand that and go through the different options there if you decide to retire early, and we can go through that with you. And then if you don't need the money, you still have to take out what's called a required minimum distribution starting at age 72. It used to be 70.5, now it's 72, so that's a benefit. And what's going to happen is, ultimately speaking, you are going to be able to defer that up to age 72. Then you're going to be forced to start taking distributions from it, whether you need to or not, and you'll be at whatever tax bracket you're in at that point in time. Now, the Roth IRA acts kind of similar, where you can defer it up to age 59.5. If you take it before then, you're going to be taxed and penalized. But once you cross age 59.5 and it's been there for at least 5 years, all the growth on it's tax-free. So it's going to grow more rapidly at that point, and it's going to minimize the taxes for you or your beneficiaries if you decide to pass it on, because you're also not required to take it out once you turn 72. So if you're able to build up a Roth IRA in addition to your rollover IRA, that gives you more flexibility come age 72 to pick and choose where you're taking your withdrawals from, so you can minimize those taxes. Because let's face it, even if your income level doesn't change, it's a chance that tax brackets might go up with all the spending we've been doing across the board for the last 2 years. So let's look at an example, and I'll zoom in here in just a moment because it's a little bit busy, but let's look at that little paragraph below, because that's really what you need to know. Ultimately speaking, Roth conversions are beneficial if you believe your tax bracket is going to be similar or higher in the future, even if at a low rate of return. We ran this example just assuming 5% rate of return just to give you an idea. But it used to be that everybody thought, okay, I'm going to defer my taxes because I'll be in a lower tax bracket when I retire. That's not the case with everybody now. We're seeing people build up pretty good nest eggs in their 401ks and IRAs, and so when they start taking money out, they could still be in the same tax bracket, or factor into that, they could be spending less, but with all the inflation we've seen and all the spending the government's been doing, it's likely we could see tax brackets go higher from here. So even with less spending, you could be in a higher tax bracket. So The benefit here is if you think you're going to be at least the same or higher, then it's definitely going to be a benefit. But even if the tax brackets go down, it could still be a benefit for you or your beneficiaries over the long term. Just might have a longer break-even point. Let's kind of zoom in on this example. Let's assume that you had $50,000 that you stocked away in the 401k, and you could do a rollover to a Roth IRA with that. Or excuse me, I'm sorry, this is not a rollover, this is a conversion option, so I apologize about that. So let's assume you had money in your IRA and you went to convert it over to a Roth, and that was $50,000, and let's assume that you're in the 24% tax bracket right now, and you assume your tax bracket is going to stay 24%, and you're 50 years old. So what's going to happen is, let's assume you're going to retire at 65, and you're assuming a basic 5% rate of return. So that $50,000 is going to cost you about $12,000 in taxes right now. And so if you pay that and let that continue to grow, these are the results you'll actually see over that 15-year period. If you were to look at that Roth IRA and you stayed at the same tax bracket, you're going to be more beneficial there, netting about $103,000 and change. If you just kept it in the IRA or the 401k, it would actually be about $79,000. And the other option we did was looking at whether you wanted to actually take that tax and reinvest it, that $12,000, you'd be at about 101. So again, really at about that same level as where you're going to be similar. But if you did look at that across the board, the Roth versus the IRA is going to be more beneficial for you, even at a low rate of return over that time period. But if you factor in, okay, what if I took the money I would pay the taxes and reinvest that elsewhere, then it gets a little bit more of a question as to where it's going to benefit you. But just give us a call. We can run this for you side by side. Obviously, look at different rates of return, different time periods, show you what the break-even analysis would be, and what interest rates, how tax brackets would have to change to make it worth your while. But generally speaking, for most individuals with the uncertainty of where tax brackets will be in the future, a Roth conversion is a good strategy, because you can slowly, year by year, get this out of your IRA or your 401k, and minimize the taxes you have to be looking at for the required minimum distribution. And even if you don't use it, it's going to be beneficial for your beneficiaries, because they're going to be able to take that distribution without having to pay taxes on it as well. But right now, the best way to review this is, again, by running a plan with us. Right now, about 3/4 of Americans over 50 don't actually have a written plan. If you can spend about 10 minutes with us gathering some data, we can run that cash flow analysis we talked about before, kind of show you where you are on the scheme of things, if you're on pace to meet your retirement goals, or if you need to make any changes to the retirement date or the saving strategy. And by knowing this can help back into some different Roth conversion strategies, whether you can max out your after tax to get that rolled over, or whether it means that you're going to actually do some Roth conversions once you retire, or even now while you're working. We can go through all those different options for you. But by doing this is the best way to kind of see where you land. Now, again, everybody's going to be a case-by-case situation, so just give us a call and we'll schedule some time. It's 1-800-900-5867. You can also reach us at info@theretirementgroup.com. If you got a cell phone out, you can hold up to the QR code and get in there to schedule a meeting with myself or one of the other advisors in the offices. Or you can also hook up with us on LinkedIn, so you can follow along with either company-specific updates or other webinars that are going to be more generic across the board that we're putting on as well. So I know we covered some different items, but like I said, it's going to be case by case for your individual basis, so give us a call. But let me see, we had, I think, a few questions come through, so let's kind of address those first. And the first one, do Roth conversions make sense when my portfolio is down? Okay, so that's perfect for right now, because we have obviously seen the market pull back year to date in 2022. But if I had a crystal ball and I knew what was going to happen, yes, when the stock market's down or when your portfolio is down, that's a better time to actually convert or do a Roth conversion, because what's happening is, again, you pay taxes when you do that Roth conversion, so you're paying taxes on a lower amount, and when you get that rebound, you're getting that rebound eventually when it's tax-free. So let's assume, I don't know, I'm gonna make up a number. Let's say $100,000 that you're able to let's say you had $100,000 at the beginning of the year, and the market's down 15%, for instance. So now that $85,000, if you're going to convert that $85,000, you're only paying tax on the $85,000 versus if you did at the beginning of the year, it would have been $100,000. So you're saving taxes right there, and let's just assume that eventually it comes back up to that $100,000 or beyond. You're getting that tax-free growth on top of that $85,000. Whereas if you kept it in there and let it grow back with the $100,000 and then convert it, now you're paying tax on that $15,000 of growth. So yeah, good question. If we knew where the market's going to go, if we knew when to do this, the best time to convert is when the market has had a pullback. It's just a question of how long will that pullback remain. Can you speak to how a Roth gets factored into a plan? So yeah, I think we kind of talked about this already as far as the plan. But one of the best things to look at that cash flow analysis is once you do retire, before age 72, you have that RMD kick in. Let's assume somebody retires at 62. That gives them 10 years of good planning. One of the things we do a lot of times with clients is we'll look at whether a Roth conversion makes sense year by year, because tax brackets change, needs change. We usually wait until about the fall, maybe October, November. That way we know what has already happened most of the year, and we're not caught off by any surprise distribution somebody was taken. So we know where you are going to fall in your tax bracket for the end of the year. And then let's assume that we run it and maybe you're in the 12% tax bracket, but you've got another $20,000 to $30,000 you could take out at 12%. Then we're going to tell you to probably convert that to a Roth IRA, pay that 12%, because I'd assume that that's a pretty low tax rate, and you're not going to see one better than that down the road. So we can look at doing that year by year. We're with a lot of clients that go even higher in the 22 or 24% tax bracket. It's just the more you pay now, the longer that break even may be for you. But it's definitely something that can benefit you, because the more you have, the more you'll pay taxes on at 72 and beyond when that RMD kicks in, if you have that all embedded in an IRA or 401k. And then one more, and we'll wrap it up. How can I take advantage of Roth conversions during the down stock market? I think we kind of alluded to this on the first question. Yes, if we knew what was going to happen, and crystal ball, if in January I had $100,000 in that same example, and I knew that the market was going to go down 15%, then I would wait until it goes down that 15% to do that Roth conversion. Because again, like I said before in that example, I'm paying tax on a lower amount, on that $85,000, not the $100,000. So going right back to that same question, yes, you can take advantage of the market right now, having been down. If you want to look at a Roth conversion, now's the time to do it. And so we kind of factor that, and we're doing that right now with clients, where usually we wait till October to run the Roth conversions. We may look at it and say, okay, are you pretty sure you're not going to have any other distributions where there may be some other tax issues? Because once you do a conversion, you cannot correct it anymore. You used to be able to recharacterize it, but you can't do that anymore. So we might take advantage of the lower market right now and do that conversion now, versus simply waiting until October, November, like we might do from normal years. But a lot of good questions, and again, the best way to look at this is by giving us a call and looking at it independently on an individual basis. But like I said before, we work with a lot of different companies, so we can look at how your company plan factors into the aspect of doing after-tax contributions and rolling those over. But we are not employed by nor are we endorsed by your specific company. However, we have been working with a lot of them for quite a long time, up to 30 years in some cases. So we have a good understanding of those plans. But when you have some time, just give us a call at 1-800-900-5867. We'll be happy to go through this whole process with you. I want to thank everybody for joining me. I hope you have a great day.